For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Thank you, me, and thank you, Professor Plum. And I'll thank all of you listening. Let's do that. Let's thank everybody. You people listening. Professor Rick Plum, that's an inside joke. Welcome to the show again. Thanks for showing up.
I know the you people thing was me 30 years ago, but I can't even remember the context it came out.
I can't either. We tease Professor Plum because you're a pretty smart guy, and when you were talking to a group of people.
Was it the industry one?
Yeah, I believe so. I think you were in
you
Phoenix.
People got to learn something. I basically chastised a group of professionals.
Weren't these were these insurance people?
Professionals?
Right.
I'm getting it. Yeah, it's coming back to me.
And they were salespeople, which
very sales-oriented.
You had to be, I guess. And
I was not.
You were not, and you knew how the thing worked, and you knew beyond the sales
how the product worked.
They were on the sales end, and you came in and finally got exasperated with the questions they were
You people
asking.
need to learn your products.
You people learn, and that. Our guest has been Professor Plum. Thank you very much. And
I was not asked to return after that.
Played off considerably by the people who were, So the you people thing has been a big deal with us with Plum
30 plus years.
For more than 30 years here. All right. Well, listen, you people listening need to hear this particular podcast because we're going to be talking about taxes. No, don't run away. Don't run away. This is good stuff.
It's that time of year.
It is, and I did a show. We did a show here a year ago, I guess, or so.
Probably about this time for this reason.
Similar to that, and it was why understanding tax brackets is crucial. I'm going to talk about that, but I also want to talk about this existent, non-existent, existent 0% tax bracket. So let's talk about how this works. If you go and look at tax brackets.
The tax tables.
I have the tax tables here.
Yeah.
And I look at this, and it's fairly simple. Tax brackets for 2024.
If your taxable income as a married couple filing a joint return is between $0 and $23,200, you are in the 10% tax bracket.
Right, which tells me that if I make anywhere from $1 up to $23,200,
I owe 10% on that.
10% on that. And then the next one says if you make $23,201 all the way up to $94,000 and change, $94,300, then I'm taxed at 12%.
Right.
And then it keeps going up.
Not a big difference, but 2% more.
2% more. Then I look and I say, well, wait a minute. Now, if my income this is married, I'm doing married filing jointly. There are others for single and separate and all that stuff. Okay. If I go to $94,301 of income, taxable income,
I
jump from 12% to 22%.
Right. A pretty good sized jump.
Big jump on that. Now, I go between that takes, there's a lot there. You can have income up to $201,000 and change while you're in the 22%. Now, if you make $201,000 and change, you're at 24%. Okay, so on and on up to 37%. If you're over $731,200 in 2024 of taxable income, you're at 37%. Now,
right.
Okay, I'm going to play the part of somebody. This is very common. This is, it's misleading to look at these tax brackets because if I'm somebody that says, hey, let's say I make, I do well. I make, my taxable income is $210,000. Let's just say
that puts you in the 24% tax bracket,
right? And I would look and I say, wait a minute. So I made $210,000. That means that almost 25% of that, I lose about 25% of that to taxes. So
you are
rounding,
you are in the 24% tax bracket,
right? So rounding, I would guess that I would have to pay what, $50,000 of taxes.
Well, the good news is
on that money.
The good news is you'd be wrong.
Well,
now you are in the 24% tax bracket
at that supposed income.
At that taxable income level. But the good news is you're only taxed at 24% on the amount over that first threshold.
Okay, so this is where the first bit of misinformation or misunderstanding happens with tax brackets, and we're going to get to the zero thing in just a moment. But you have to understand how this works. So Professor Plum talked for just a moment about how if I made $210,000, and I picked that number because it's firmly in the 24% tax bracket.
Right, because the 24% tax bracket starts at 201 and change.
Right, so I'm at 210. I'm firmly in the 24% tax bracket. I believing, just from looking at this, that I have to pay $50,000, give or take, of income taxes.
Like I said, the good news is you don't, because...
All right, how does it work? Let's explain that.
You go back and say, I've got $200-some thousand. The first $20,000 and change is taxed at 10%. Actually, $23,200 is taxed at 10%. Let's take that off the table. Now, the next, give or take, $70,000, the difference between $23,200 and $94,300 is taxed in the 12% bracket. And then the next $110,000 or so is in the 22% bracket. And then you just stack them on top of each other.
And then the last...
It doesn't go back. When I go into the 24% tax bracket, it doesn't retroactively tax all these previous brackets at the 24% bracket. No. They're still taxed at the 10. They're still taxed at the 12, the 22, and then some of my income is in the 24. So I look at them as, in that case, I've got 4 different brackets that I'm in. I do the 10% of the first block, 12% of the next block, 22% of the next block, and then 24% of that final $8,500 or so. And then I add those numbers up to find my tax bill. It's still not a nice tax bill. I'm not saying it's good. It's not 25% or 24% of the overall, though. So it's better than that.
You have an idea of roughly what it would be in that example?
Oh, you want me to do math that quick?
No, I don't really want you to do math because you like to be exact. But it would be something less than 25%.
I'd be less, yeah. Well, I mean, the majority of it, more than half of it's only at the 12% bracket.
Yeah.
So you would figure that half of it is going to be, so you're probably in the $30,000 range.
Okay, so $30,000 of tax on $210,000 of taxable income.
But that's taxable income. So that's looking at the brackets. That's looking at the IRS website and saying, I want to know what my tax brackets are. And you look at it and says, if your taxable income is X, then you're in this tax bracket. Then you have to understand it's progressive. It doesn't go backward.
About 1/7 of my income, taxable income, in this example, would be subject to tax. Not
maybe
1/4.
Maybe it's 35,000. I mean, all right, it's close enough. But not 24%.
Okay.
Even though you're in the 24% income tax bracket, you're not paying 24% of every dollar that you have up to that point.
Okay. So there you go. That's a good thing to understand. And I know many of our listeners probably already know this because we have talked about it before, but people don't. And it's a very easy thing to become confused about or to misunderstand.
Right.
When you look at it at face value. All right.
And this is where people that get bonuses, I mean, I've heard people say, I don't want a bonus because I'll pay more in taxes than the bonus is worth.
You know, I could see that. Somebody who says, you know, my taxable income this year is $92,000. They wanted to pay me a $10,000 bonus. Well, that would jump me from the 12% bracket to the 22% bracket, and I would lose a good chunk of my...
22% of $100-some thousand is $22,000, where before I only owed $10,000, so my taxes went up 12, and I'm only getting a bonus of 10.
Right.
It doesn't work that way.
No. All right.
Now, the withholding, the reason people have that misunderstanding is the withholding is based on how much you're receiving. Withholding is how much money they take out of your check and send to the government as a prepayment on the taxes that you may or may not owe.
Yep.
And if you're somebody that, gets a check every couple of weeks for, let's say you're making $90,000 a year and you get a check every 2 weeks for $3,700, they take out enough money because they say over the period of time you're going to receive 24 checks and we need to withhold this much money. But then you get one more paycheck for $10,000
as a bonus.
That's 3 times. And they look at that saying, well, that's a regular paycheck, and he's going to receive that or he or she's going to receive that over 24 pay periods. That means they're going to make a significantly large amount, so we're going to withhold a lot more. So they on a big check like that compared to your monthly or weekly paycheck,
going to be taxed more.
They're going to be withholding more. You're not going to necessarily owe significantly more in taxes on it, but your net payment to you is a lot less because they withheld a lot more. They sent a lot more forward to the government as a prepayment.
Okay, so
you can have it changed, or a lot of companies have started saying, well, let's treat this as a separate entity and do a little less tax withholding to not scare the living heck out of people, because people were worried that getting a bonus was going to cost them more than what they were going to get.
So by listening to this podcast, they understand that that's not how tax brackets work.
No,
and
that's
if
a
you
good
need to
thing.
listen again, please feel free to back it up. Okay, so now that we've got that settled, we talked about this being taxable income.
Correct.
Now, not all of your income is taxable. I mean, not all of your income is taxed. So you have your gross income, right? That's like your wages, dividends, capital gains, business income, retirement distributions, or whatever else, right?
It's all your income.
It's all your income, everything that you brought in. Then you have your adjusted gross income. That subtracts things like, I don't know, student loan interest, retirement account contributions.
Yeah, it takes into retirement account contributions. Right. It takes into consideration adjustments that happen before it goes on the tax return.
Yes.
And one of those adjustments, which is really hard to understand, is how much of my Social Security, if any, is being taxed. I may be getting $30,000 a year in Social Security, but I may only show 10, 15, 20 of that in the taxable column as part of my adjusted gross income. So not all of my Social Security is taxable, because not all of it even shows up in the adjusted gross income column.
Yes.
So the first thing we have to do is figure out what adjusted gross income is. Take your wages less your health benefit, or the money you're paying for your cafeteria plan, whatever you want to call it, your medical insurance, things like that. Take away your
401k,
the traditional 401k contributions, things like that.
Right.
That is what goes on the tax return as a taxable amount.
And then and then below that you have your taxable income. But in between this,
right. So you come up with your adjusted gross income. You calculate how much of your Social Security is taxable. You net out your gains and losses and only put the gains that you have after taking out the losses. Your business income, you take your business expenses out of it. Your IRA deduction if you qualify for one. You take all these things to consider the adjusted gross income, and then from the adjusted gross income, you get to take a fat deduction.
Yeah. So before you get to your taxable income,
right,
you get to take.
You start with your adjusted gross income, and then you take away the greater of either a set standard amount for your filing status or your itemized deductions, whichever one is greater.
So it's known, of course, most people know, it's known as the standard deduction, which for 2024 is $29,000. I'm talking married filing jointly again. You can cut it in half for single. Married filing is $29,200.
Right.
So
if you're under the age of 65. So your standard deduction is the $29,000 number. Now, if I've got itemized deductions, my mortgage, my charitable donations, my state and property taxes up to $10,000, medical expenses that exceed 7.5% of my AGI, adjusted gross income, all of those are potential deductions. If all of those that I've made through the year add up to more than the standard deduction, I get to take that.
Which is good for people who have a lot of charitable donations, maybe, right?
And it's hard to get to. I mean, it's actually not easy to get to the itemized deductions anymore.
Yeah.
Unless you've got a very large mortgage at a fairly high interest rate nowadays. But my mortgage, if I have a $700,000 mortgage at 7%, that's $49,000 in interest. I get to take that whole interest deduction.
Well, that's true. The mortgage interest. Wait, the mortgage interest isn't capped. It's the state. Yeah.
The mortgage interest is capped in that it is only the interest on a certain amount of debt. If I have a $3 million house that I took a $2 million loan against, I don't get to write off all the interest on that $2 million loan as home mortgage interest. Depending upon when I bought that house, I may only be able to deduct the interest on $750,000 of loan value. So I am limited to that. So if, like I said, if I have a $700,000 house or $1 million house that I put 30% down on, and I have a $700,000 mortgage, 700 times 7%, today's mortgage interest rates, give or take, easy math,
yeah.
$49,000.
Yeah.
Just that by itself is more than the standard deduction. So if I've got that kind of an interest deduction, I'm going to be itemizing, which gives me a bigger reduction between my adjusted gross income to my taxable income. Then add in the fact that I'm probably paying way more than $10,000 in property tax on that $1 million house.
So. Yeah.
That, unfortunately, right now is capped at $10,000. State income tax and local tax SALT deduction is limited to $10,000. But then I also get to take my charitable deductions and my
Yeah,
medicals
that's
if
good.
it's enough.
That's good. You can take that.
So I very
higher.
easily, if I have a big mortgage, that's usually what it takes to be able to get into the itemization zone. But a lot of people now, I think it's like 90% of the people that file a tax return don't itemize. They just take the standard. Everybody gets the same deduction. That's right about $30,000.
That standard deduction was raised considerably 6-7 years ago, and it's set to sunset. As we've mentioned many times, it's set to sunset here at the end of 2025.
Right. So for 2026, we may go back to the old rules
where
we had a lower standard deduction, but we got personal exemptions, the two of them combined.
And the state and local tax maybe
the limitation on state and local tax deduction
All
goes
right.
away.
Okay. So here's what we have. So that standard deduction, Professor Plum, acts as a kind of 0% tax bracket.
Right.
You won't see a 0% tax bracket if you look at the tax case.
So if my adjusted gross income is, call it under $30,000 for a married couple, after my 401k contributions, all that, and the things that don't count on the tax return, I don't owe any income taxes.
Yeah. Now let me give an example here to make it easier for people who are listening, because I know there's a lot of numbers out here. Okay, so let's just take a hypothetical married couple, $100,000 of gross income. Now we're going to keep it simple. We'll say they have no 401k.
Okay, or we can talk about just a retired person who's.
Okay, well, whatever. All right.
Okay, so no retirement plan.
They don't have deductions anywhere. I'm just trying to keep this simple. Okay, it's $100,000 of adjusted gross income for the year, and so they say, well, I want to know how much of that $100,000 is going to be taxed. So.
Yeah, I look at the tax bracket.
Well, they look at the tax bracket. So they come here and they go, okay. So they go, okay, I understand. 10% on the first, 23 grand, and then 12%, just like Professor Plum said on the podcast, 12% on the next 70 something whatever grand, and 22% on the last whatever, 16, 17,000, something like that. Okay, so, and they add it all up and they say, okay, well, my income on that, if I have this example done correctly, add it all together is about
give or take $13,000,
which is about a 13% overall average
effective
rate.
tax
But
bracket.
Professor Plum, their calculations in this example would be wrong.
Right, because they were calculating their taxable tax brackets based on their adjusted gross income, not their taxable income. Right. You have to use the proper numbers to get the right result. So if I have an adjusted gross income of $100,000, and I'm a married couple, both of us are under age 65, I can basically reduce that by rounded up $30,000. So my taxable income is only $70,000.
Right. They should have done these calculations that we just ran through on about a little more than $70,000 of taxable income, not on $100,000. So their tax bill will actually be lower. And by the way, if you're 65 or older, that
you get an extra $3,100 of deduction.
Is that together or
together? Yeah, $1,550 each.
Okay, yeah. All right. But all right. Let's stick with this. Okay. Yeah. So what do you think the bill wouldn't be $13,000?
It'd be about $8,000.
$8,000, which on $100,000 of adjusted gross income and no other deductions, 8%.
Right.
Tax.
Right. So it's about 8% average tax on what you're showing as, your gross income at that point, or your adjusted gross income. But unfortunately, it's hard to know what these numbers are without knowing what goes into AGI, adjusted gross income. Once you get to adjusted gross income, it's pretty easy to go the rest of the way, subtract out your standard deduction, your age 65 deduction, and then apply the tax brackets. But the problem is the adjusted gross income is a moving target, especially if you have Social Security.
Well, it is. Now, this is where the planning part comes in. And I don't want to turn this into an entire, tax lesson explanation and all this stuff. What I'd like to talk about here for a few minutes is that 0% tax bracket and how you might be able to take advantage of it. Because you as a planner, Professor Plum, know more than anybody that when you've got now this year $29,000 some odd dollars of tax-free money, after all these other deductions that you've taken, I mean, you've got an opportunity for planning, do you not?
You do. And I was actually speaking with somebody this morning about this very issue. They currently are, 66 years old. They're taking money out of their portfolio to supplement their Social Security. They're taking out roughly $18,000 a year. and they're taking it all from a personal account.
So that's money that's been taxed.
Right. And so
already.
it's in T-bills and other things. So it's earning some interest, but they're using a lot of principal, and they're going to run through their personal account over the next 7 years or so. And then the only thing they'll have left is a 401k. Now, they've got plenty of money for the rest of their life. At their expected, even with some unexpected expenses, they've got enough money to meet their needs. But right now, they're taking the distribution from their personal account, and they have a zero taxable event for the year. They owe absolutely no income taxes.
But they took all that money out, or they had that income.
But they had the income. They because they're taking principal from a lot of it.
Yeah.
They've got $100,000 in T-bills. What's that earning? $5,000 a year in interest, but they're taking almost $20,000 a year out of it. That's going to last for 5 years.
Yeah.
And then they've got some other money, but then the rest of the money is going to be all taxable income. And so I talked to them this morning about, well, let's, instead of taking the $18,000 a year out of your personal account, let's take maybe $10,000 a year out of your IRA. A, you're going to slow the growth of it. And B, you're going to be able to take that $10,000 out, and you still won't owe any taxes.
Well, but wait a minute, Professor Plum, he said in his best leading question manner. Wait a minute, though, Professor. I was taking this out of my personal account, and I know I've already paid taxes on most of that. It's not, but if I take it out of my IRA, I was told that's always taxable.
It is taxable to the extent it is going to show up on your tax return as part of your adjusted gross income. But when you take out $10,000 from your IRA and you do the calculation for the Social Security, the income, the amount of Social Security that's put into the taxable column is enough that it's still less than the combination of those two income sources on the taxable column is still less than the standard deduction for this person. And so their adjusted gross income is X. The standard deduction is X plus another 1,000 or so. So their taxable income goes down to zero. So the distribution from the IRA at that level would have been zero tax. And that's a good thing, by the way. And
so the first $29,000.
Well, this was a single individual, but yes, for a married couple.
Let's say for a married couple.
Almost $30,000. And for a 65-year-old couple where both of them are 65, it's like $33,000. $32,000.
I can make $32,000, and I guess
you can have $32,000 of adjusted gross income.
I could be working a job.
Oh, sure.
Yeah.
Yeah. So maybe you make $60,000. You put 30 of it away in your 401k, and your tax or your W-2 says $30,000 after expenses. You're paying no taxes
on that amount of income.
Right.
And this is how you use what's called the 0% tax bracket.
We always have to be looking at what can we use to an individual's advantage. We've talked about it many times. Taxes are an expense that we may be able to manage to some degree. And this is one expense that we pretty much universally can say, I'd rather pay a smaller expense. Most people don't say, I want my tax. Now, I will say it in a roundabout way. I'd love for my taxes to be higher than they are right now. Not as a percentage, but as an overall tax bill. I would love to be in the California 13.3% tax bracket, because that means that I'm making $2 million a year or some $1.5 million or more. I'm not there yet.
No,
it wouldn't be. I would be nice, but at that point I would owe 37% federal, 13.3% California, and I would probably be complaining bitterly all the way to the bank.
Well, that's true, and that's
that's a different way to look at it.
But nobody at any income level likes to pay taxes.
Right.
In some cases, you can't avoid it.
So let's find a way that, given the income level that we have, I mean, in my scenario, I was dramatically increasing my income. Who wouldn't want that? Yes, you have an additional tax bill that comes along with it, but you also have a significant increase in income. I'll take it. On the other side, we have people that have straight fixed income, or we're on a similar income every year. And now let's see what we can do with that tax bill, that expense. Can we somehow reduce or manage that expense so that it makes a more efficient use over time? Maybe today, the future, in somewhere down the line.
That's how you look at it as a planner. So I'm somebody who's got IRA money, 401k money in these accounts, and I've got personal money over here. And I not understanding, let's say, necessarily how the tax brackets work, as you said earlier, maybe I've been taking this personal money out and living on that because I'm afraid to touch.
Well, I don't want to pay any taxes.
I don't want to pay taxes.
Not paying any taxes.
Right. I don't want to take money out of my 401k. I don't want to take it out of my IRA. But what you're saying is, hey, I can take the first married couple again. I can take the first almost $30,000 out of my 401k or my IRA. And even though it's quote unquote taxable, I will pay no tax on that.
Right. And like this person I was talking to earlier, we take some money out of the IRA now and pay no taxes. We're still not paying any taxes. Yeah. It'll reduce the taxes that they're going to have to pay later on because, after 6-7 years, or however many years, their personal portfolio is going to be gone. The only thing they're going to have left is IRA money. And if they keep taking $18,000-$20,000 out of that, now not only is $8,000 to $10,000 of that IRA distribution going to be taxable, but it's affecting the taxability of their Social Security. So their tax bracket or their actual taxable bill is going to go up. I mean, they're never going to owe, huge amounts of taxes, but it's an expense they can avoid at least partially.
Well,
why not?
Well, why not? And even if you go beyond that standard deduction as a married couple, even if you go beyond that and you take it up another $10,000, $15,000, $20,000, you're paying that extra above the $30,000 standard, you're paying a 10% tax.
Well, you're in the 10% bracket.
Do you? Yeah.
But if you are a Social Security recipient, you may not be paying 10%. If I can take my number right up to the point where I've got zero taxable income, I've used up my deductions, I've used everything up, I've got zero taxable income. If I take another $1,000 out, it would show up in the 10% tax bracket. Mm-hmm. But assuming that not all of my Social Security is taxable yet, or all that can be taxable, I may not be paying 10% on $1,000. I may be paying 10% on $1,850 because $850 of Social Security that was previously not taxed now becomes taxable because my modified adjusted gross income, another adjusted gross income calculation, just went up by $1,000, which made more of my Social Security taxable. So yes, I'm in the 10% tax bracket, but I just paid $1,800 on that, or on that $10,000 distribution,
which is more than 10%.
That's 18%.
Yeah,
that's because I'm not. That's because of the sliding scale of inclusion of taxability of Social Security.
So just when you thought you had it all figured out, and you knew that you have a 0%, and I'd say, well, I'll take a little more because I don't mind paying 10% on this.
10% is cheap. 18 is a little more.
If you're taking your Social Security, you have to understand that could kick some of that Social Security into the taxable column. And this is where somebody like you who understands this can help.
Right, and it's interesting because there's some, depending upon how much of your Social Security is already taxable. So if I take 10 out, maybe another $850, take 10,000 out, maybe 8,500 of my Social Security becomes taxable. But that may be topping it out. Now I'm not taxable anymore. My Social Security's, I'm already at the
You're already at the top.
So if I take another 10 out, now I'm back in the true bracket. So if I'm looking at the effective cost, it was 18% for the first 10, but it's only, 12% to take out 20. It may actually become more cost effective to take a little more out.
Well, and the reason you would take a little more out, even if you don't need it to spend, is because you're getting that money out of that
at an effective or efficient rate.
What does it cost you to take it out? It could be cheaper now than it will be in the future, 10 years from now or whatever.
And you said, even if I don't need it, but there's this wonderful thing, especially before you get to age 73 or 75 later on, called conversions.
Roth conversion.
You can take money out of your IRA and put it on the tax return today and have it wiped out by the standard deduction if you're in that kind of a situation, and just do a conversion with it. Put it in a Roth IRA so that it'll never be taxed again.
Why would you not? Well, you don't like to give up free money. You don't like to give up a 0% tax bracket. If they're telling you that you can take $30,000 or some amount of income totally tax-free, you shouldn't pass any of that up, right?
Now, most people, their incomes, even in retirement, are not low enough where they're going to get the true 0% because they've got Social Security, they've got
understood.
But we can still do things with the lower brackets, understanding that not all of your incomes. The whole idea today was to look at this, say, look at not all of your income is taxable. Understand your tax brackets. Understand what it's costing you to do a distribution or a conversion. And then look at what happens if you don't. What happens in the future if you don't? Well, I didn't take any money out of the IRA, and hopefully it grows. I'm, 67 years old. I got 8 years before, 6 years before required minimum distributions. And so that IRA could maybe go up by 60, 70, 80% by then.
Potentially. We don't know.
Which means that the distribution will go up by quite a bit. My required minimum distribution is going to kick in at some point, and I'm going to have to then.
You
at
can't
that point,
play with it.
I can't avoid.
Well, you can't. You lose the ability to take out what you want.
I can't mix and match because I've got
there's a required
bogey
minimum.
I got to hit.
There's a required minimum. There's a this is, I find this fascinating. I know you people listen to taxes. They say, what? I find this fascinating. If you folks have been able to follow this, you people.
See, it's not just me.
I said you folks. You say folks, it sounds better.
I wasn't trying to sound better than.
I know you weren't. You don't.
They were ticking me off.
You showed me a sales brochure. I won't get into it today, but you showed me a sales brochure on these, what they're called, QLACs, Qualified Longevity Annuity Contracts.
Just a little misleading.
A little misleading. As you and I were going through it, it was a lot misleading. Maybe we'll talk about that sometime. But the whole tax thing, while it's somewhat simple on its face, this is why we went through this today, to show you how understanding how the tax brackets work and taxation of each individual bracket works. It may make you a better investor, and it may actually save you some in taxes.
Oh, and that 94.2 that we were talking about that's in the 12% bracket?
Yeah, 94.3.
94.3, excuse me. And if you have capital gains as part of that 94.3, the number isn't exactly 94.3, but it's in that same range.
Yeah.
If your total adjusted gross income is $90,000 and 20 of it is from long-term capital gain, guess how much the tax is on that long-term capital gain?
Gee, how much?
0.
Look at that. Capital gains are fun.
So there are times we've talked about tax loss harvesting, finding losses to offset gains, but there may be times where you look at this and say, you know what? I have already my Social Security's maxed out. I'm already there, and I've got another $20,000 in the basically in the 12% tax bracket. They're not exact, but they're close. Maybe I'm going to sell something at a gain and buy it right back, but reset my basis for the future so I don't have to worry about it when I want to sell it, when I need the money, and I don't have to pay taxes on it then.
These are, these are techniques that Professor
Harvesting
Plum...
gains.
Well, we talked about that toward the end of last year. We talked the previous year about harvesting losses in 22. Well, people had some gains in 23.
Yeah, thankfully.
Yeah, and at least so far, this seems to be continuing. You want some more? You want help on this stuff? You want somebody like Professor Plum to go over this situation with you to see if you can maybe save taxes? Maybe you're not taking advantage of these brackets the way you could. Give them a call at Lucia Capital Group, 800-644-1150, 800-644-1150. They're here to help you. Professor Plum, you are the Chief Financial Planning Officer for Lucia Capital Group.
I am.
So you look at these, and oftentimes...
I talk to the advisors. We talk about these things all the time. They'll come in and say, okay, what's going on with this return?
Exactly. But you guys find it fun, and...
I know, it's kind of weird, but we do.
We do, and I like to emphasize that, because if you find something fun, then it becomes a puzzle, it becomes a game, and you really get into it. And you say, how can I stick this to the man, right? As they say. 800-644-1150. Go online, luciacap.com, LUCIACAP.com. Find all these resources online, videos, podcasts like this one, copies of that. You got white papers, whatever you want. Resources are all there at luciacap.com. Don't forget to subscribe to this podcast. Please do so, because you'll get information like you got today. All the time, every single week, downloaded to your device. You go to Spotify or Apple Podcasts, and you can find us right there and subscribe. Do that. We'd love to have you. People, I love it when the podcast grows. Professor Plum, thank you so much. I know you got another meeting coming up here in just a few minutes, so I'll let you go. My thanks to Professor Rick Plum, who, by the way, is a certified financial planner professional. You are a CFP.
Also an accredited wealth manager and advisor.
Oh, is that now? Do I have to throw that in?
I don't know if you have to throw it in, but I am one. So.
Accredited wealth manager advisor?
And management. I have to look up the...
Get it right. And
AWMA.
All right, we'll get it right, and we'll give you those props next week. For Professor Rick Plum, CFP, I'm your podcast host, Johnny Dean. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.